Hey, what's up, my friend? So, in today's episode, I want to share with you on how you can go about finding high probability breakout trades. So, in essence, right, what I'm about to share with you are the things I look for, right, to find the best of the best, the highest of the highest probability breakout trades. And I'll be honest, right, sometimes you just can't get all the stars to align, but if you can get, as many of these stars to align, right, you are pretty much in good shape. Okay, so here are the things I look for. Number one, if you're trading stocks, right, or whether you're trading currencies or whatsoever, you want that instrument to be trading at all-time highs. I think this is something common, right, for stocks. And the reason for this is that if a stock is trading at all-time highs, what this means is that the stock is pretty darn bullish. There's little to no selling pressure. People are just, flying on board, right, wanting to get a piece of the action of that particular stock. And here's the thing, right, about buying stocks or buying any other markets or instruments, right, that is trading at all-time highs, is that there is no price structure where sellers can lead against to short the markets. So let me explain what this means. So if a stock, right, let's say it's trading at all-time high, if you look to the left, I can assure you that there is no swing high, there is no resistance where sellers can use those levels, right, to time their short entries, because the stock is at all-time highs. Unlike a stock that, let's say, it is approaching resistance, about to break out. If you look left, right, there might be resistance, there might be swing high. But for a stock that is trading at all-time high, there is no such thing. And that's, really sweet, right, to be a buyer, for such stocks, right, and to look for, breakout opportunities when a stock is trading at all-time highs. Number two, you want that particular stock, okay, to have a high rate of change. So what this simply means is that, let's say, over the last 12 months, okay, let's say you have two options. Stock A has increased 30% in price. Stock B has increased 100% in price. Which stock do you want to be buying? I hope you choose stock B, right? You want to be buying stocks which are strong, stocks that have moved a lot, right, recently, because these are the stocks, right, that are likely to continue, right, to outperform the market. So one simple way is, again, right, just look at the rate of change, or rather the percentage change over the last 12 months, the last 6 to 12 months. Those that has moved the most during those period are the ones likely to outperform the market. Number three, third thing, you want to have, the breakout, right, the range, right, to have at least 80 candles or more. So if you are trading on the daily time frame, that means the market has been in the range of at least 80 days or more. And the reason for this is quite simple, is that it's based on my experience, right? The longer that the market is in a range, the harder it tends to break. So the longer that the market is in a range, right, what happens is that traders who notice the range, they look to buy low, sell high, buy support, sell resistance. And when you buy support, sell resistance, right, at the ends of the range, right, it will accumulate more stop orders. So let me explain. So let's say if you buy at support, where will you put your stop loss? I'm guessing you put your stop loss, below the lows of support, right? That's where your stop loss is. And if you think about this, right, someone who is long at support, their stop loss is in essence a sell stop order, right? So if the market, goes against them, it hits their stop loss, there's a sell order to get them out of their long position. And likewise, right, if you are selling at resistance, your stop loss is probably above the highs of resistance. And that stop loss is a buy stop order. So if you're short the market and if you want to get out of the trade, you need to buy back, right, what you have sold earlier. So that's a buy stop order above the highs of resistance. So the longer that the market is in a range, the longer this, stop orders will accumulate above the highs of resistance and the lows of support, right? And when the market eventually does break out of the range, right, it can be fast and furious, because many traders rush for the exits, and it can push the price, right, much further at the breakout point. And on top of it, momentum traders stack onto the come to the party and join in, right? They can even push the price much further. So the longer the market is in range, the harder it breaks. And that's why I look for at least 80 candles or more, right, when you're trading breakout. This is one thing to look for as well. Number four, a build up. So here's the thing, right? Before the market breaks out, you want it to form a build up. Some traders can call it a tight consolidation. Some traders call it a volatility contraction. So meaning, right, when the market is in a range and let's say it approach resistance, you want it to consolidate at the highs of resistance. And there are a couple of reasons for this. First reason is that Number one, it tells you that there is a sign of strength. It tells you that buyers are willing to buy at these higher prices. That's why you have this consolidation at resistance. Okay. Number two, when there is a consolidation at the highs of resistance, there is a reference point, which is basically the lows of the consolidation where you can set your stop loss. So imagine, right, two range market. One range market is the market just go up, down, up, down. If you buy the breakout of resistance, where is a logical place to set your stop loss? Possibly below the lows of support. In another condition, let's say the market is in a range, up, down, right? But this time around, it forms a build up at the highs of resistance. If the market breaks out, where can you put your stop loss? Well, you don't necessarily have to put it below the lows of support, because you can just set it below the lows of the consolidation, below the lows of the build up. This gives you a tighter stop loss, which improves your risk to reward on the trade. Okay, so this is why the fourth thing is, you want to look for is a build up. And the fifth thing is just a quick one, is that, if you follow the four things that I've just shared with you, the fifth one is simply, to make sure that market is trading above the 200-day moving average. Just to make sure that, you are buying in a long-term uptrend. But, if you follow the earlier tips that I've shared with you, most likely that market will also be above the 200-day moving average. But I just want to, put it out there, just make sure I don't miss it as well. Okay, so here are the 5 things, right, you want to look for to identify high probability breakout trades. Number 1, the market is trading at all-time highs. Number 2, the stock has exhibit strong momentum, right, over the last 6 to 12 months. So basically, it has a high ROC value, high rate of change value, right? The larger the price increase, the better. Number 3, you want the range to be at least of 80 candles or more. If you're trading on the daily time frame, that's 80 days. For the weekly time frame, it will be 80 weeks. Number 4, breakout with a build up, basically looking for a tight consolidation prior to the breakout. And number 5, the market is in a long-term uptrend above the 200-day moving average. So with that said, I have come to the end of this episode, and I'll see you in the next.